Yes, ma'am.
Let's see another question where we calculate both ROI and RI. RI, we didn't. So there's a question here. Sports company. Let's first read through this question. Sports company is a large manufacturing company specializing in the manufacture of a wide range of sports clothing and equipment. The company has two divisions, clothing division C and equipment division E. Each division operates with little intervention from head office, and divisional managers have autonomy to make decisions about long-term investments. Sports company measures the performance of its divisions using ROI calculated using controllable profit and average divisional net assets. See, most commonly we see that it is the average divisional asset which is used in the denominator. But very specifically, like in the previous question, if it says that we have to use controllable investment, we would go ahead with controllable investment. In all other situations, generally the formula that is taken up is average divisional net assets. The target ROI for each of the divisions is 18%. If the division meet or exceed this target, the divisional managers receive a bonus. Last year, an investment which was expected to meet the target ROI was rejected by one of the divisional managers because it would have reduced the division's overall ROI. Consequently, sports companies considering the introduction of a new performance measure, RI, residual income, in order to discourage this dysfunctional behavior in the future. Like ROI, this would be calculated using controllable profit and the average divisional net assets. So, for the purpose of calculating RI also, we would calculate the weighted average cost of capital on the average divisional net assets. So, that's very clearly given. ROI and as well as RI also use average divisional net assets. The draft operating statement for the year prepared by the company's trainee accountant is shown below. So, there's an income statement given. We have the net profit as well as the opening and closing divisional controllable net assets. So we can calculate what is the average divisional net assets. Okay, there's some other information given to us. Notes 1, it says that included in the fixed costs are depreciation costs of 165,000 and 460,000 for division C and E respectively. 30% of depreciation costs in each division relates to assets controlled but not owned by head office. Division E invested 2 million in plant and machinery at the beginning of the year, which is included in the net assets figures above and uses the reducing balance method to depreciate assets. Division C, which uses the straight line method, we see that fixed costs are depreciation. And these are the amounts. 30% of depreciation cost in each division relates to assets controlled but not owned by the head office. Division E has invested 2 million in plant and machinery at the beginning, which included in the net assets figures above and uses the reducing balance method. Division C, which uses straight line method, have made no significant additions to non-current assets. It is the policy of both divisions to charge a full year's depreciation in the year of acquisition. Head office recharges all of its costs to the two divisions. These have been included in the fixed cost and amount to 620,000 for division C and 700,000 for division A. Sports company has a cost of capital of 12%. Calculate ROI. First, let's calculate ROI. Then discuss the performance of the two divisions for the year, including the main reason why their ROI results differ from each other. Explain the impact. Then we see calculate RI. Discuss about the advantages and disadvantages of using RI. So let's go to the Excel sheet. I've pasted the question already. If it is calculation of ROI, I will do it here. So the formula says ROI is equal to controllable profit so division C and division E. So controllable profit. See we see contribution is there and fixed cost is there. So fixed cost is not separated as controllable fixed cost and uncontrollable fixed cost. Just one amount of fixed cost 945 and 1420 is directly given. But the notes has certain things which are mentioned. Included in the fixed costs are depreciation costs of 165 and 460. Those are uncontrollable. They're committed costs. So we have to eliminate these amounts from fixed costs. Okay. From contribution margin, only those fixed costs which are controllable in nature have to be deducted. That's one thing. After that, see there are investments related to 30% of depreciation cost in each division relates to assets controlled but not owned by head office. Okay, it's not the entire amount. 165,000 and 460,000 are depreciations, but So they are controlled by head office. So only how much would it come? Okay, the way we present, we will take it. Okay, fine. Only 30% has to be done. Um, Second point. Head office recharges of all of its costs to the two divisions. They have been included in the fixed cost amounted to 620,000 and 700,000. So these things also have to be adjusted. 600,000 and 620,000 and 700,000. So for depreciation wise, first we need to separate what portion of it is. See, the statement can be presented in two different ways. See, for the purpose of calculation of controllable profit, we start with contribution, separate the controllable uh, fixed cost, and deduct only the controllable fixed cost. That's one procedure. See, controllable fixed cost out of this is only 70% of the depreciation amount is controlled by the division manager. So separate that from the depreciation cost, calculate that and deduct that and arrive at what is controllable profit. Second method is we start with net profit. All whatever was deducted which is not controllable in nature could also be added back. So that is another method. So if we look into that, see the amount of fixed asset is 945 for division C. The total other fixed costs are um, given here is 945. The other two items are 165. The 165 is one item. The next item is 620. When we add them up, it's coming to 785. So which means that there are certain other amounts of fixed costs also included. 945 is given as fixed cost. We have mentioned about only two fixed costs. One is 165,000, the other one is 620,000. When we add them up, it is only 785. So there are other fixed costs also included in that. So only calculating that and then separating that may not be an appropriate method. So what we do is all whatever is uncontrollable can be added back. They were deducted. They are already deducted and we have the net profit. So what we can do is what should not have been deducted are added back. You must have studied in income tax also. See how to arrive or NOPAT calculation. I don't know whether you remember that or not. See whatever is not required are added back, adjusted back. Earlier, whatever was deducted, which is not supposed to be deducted, is added back. Whatever was added, not supposed to be added, is deducted. So that is one way of doing that. So we'll follow the second method because these amounts and the amount that is given in the income statement do not match with each other. So we'll start with the net profit. Uncontrollable expenses. Out of that, one is depreciation. Depreciation, 30% of it is uncontrolled because that is under the control of the head office. So Here we have it as 165 into 30%. Here we have it as 460 into 30%. This has to be added back. Another thing is second note to head office recharges all of it costs as 620 and 700. These are allocated because they are also uncontrollable. So 620 and 700 should be added back. What charges these are? Head office head office costs. That's numerator. We need to know what is average divisional net asset. Average divisional net asset, let's write it here. It is the average of two figures, which is 13,000 plus 9,000 and divided by 2. To calculate what is ROI, that's calculation of ROI for 6 marks. Second bit, discuss the performance of the two divisions for the year, including the main reasons why their ROI results differ from each other. Explain the impact the difference in ROI could have on the behavior of the manager of the worst performing division. So we are converting them into percentage wise. Whatever is the investment, whatever is the activity, everything was converted back into percentages. But the percentages that were calculated show the values as 19% for one division and 17% for another division. Question is, why is there a difference? So that has to be answered. What do you think? Why is there a difference? Not a very lengthy questions, very simple details are given to us. The first thing is introduction, then we see there's a target ROI set. What answer do you have to give if we are to ask about why is there a difference? Any answer you have?
Division C, ma'am.
No, the question says that division C has 19%, division E has 17%. The question is, um, discuss the performance of two divisions for the year, including the main reason why there is a difference in the answer. Why is that only one has 19%, the other one has only 17%? The target ROI is 18, 18 only, no? So something we have underlined also. What's the target ROI? Target ROI is 18%. So on that note, we would see that only the activity of division, um, first division, see, I don't know. First division would be accepted. The other one is would be critically evaluated because the ROI is less than the standard ROI. Okay, that we will discuss. But why is there a difference in the answer? Okay, why is there a difference in the answer? We'll focus on what is the formula. The formula says for an amount of investment made, what is the amount of profit earned? But of course, we have converted that into percentages. Division E has higher amount of investment. Division C has a lower amount of investment. 27,000 for E, 11,000 for C. So on that note, the quantity of amount, your amount of profit that is generated also is low. But this, since it is made into percentages, what reasons could have been there? In spite of that, it sees even with less amount of investment also, we see that C has done better than E. That part we have to discuss. That's the concept what we have to discuss. Let's look at the what's the nature of activity that is carried on in each of the divisions. Because with that such a small set of information, we may not address this question. So let's get into the intricacies of what is the nature of each department, what are they into. First division is clothing division, second division is equipment division. Okay. Each division operates with little intervention from head office. Then we see that target ROI is 18%. Then last year, an investment which was expected to meet the target ROI was rejected by one of the divisional managers because it would have reduced the division's overall ROI. Anything for you to add? They have rejected one project. Last year, an investment which was that was the dysfunctional thing. See, a project with an ROI, investment with an ROI was less than the target ROI. They have. Do you think this could be one reason why there was an impact on their profit? Then, apart from the depreciation part of it, division E, the second division, invested 2 million in plant and and machinery at the beginning of the year, which is included in the net assets figures above, and uses the reducing balance method to depreciate assets. Division C, on the other hand, uses straight line method. See, last year they have invested um, 2 million. Second division, E has invested 2 million. So their denominator increased, their assets have increased. Okay, assets have increased, and reducing balance method, in the initial years, higher amount of depreciation will be charged. So last year only they purchased. So this year definitely the depreciation amount would be at its highest value. So they've deducted depreciation, okay, on 2 million, whatever is the percentage applicable, which definitely would be a higher portion of it because it is on the original cost. So their profit also has reduced. Okay, that can be looked into. Division C, on the other hand, the first division uses only straight line method. Straight line method is consistently the same amount of depreciation charged year after year. So these things will be the main reasons why there is an impact on division E. Division E, though it has high amount of investment and good amount of profit, the profit was double the amount of division C, but still they have 17.73. These are the reasons. Investment increased, the denominator increased, and on the investment in assets, depreciation method followed by division E is reducing balance. So the current year, the depreciation amount would have been at its highest, which impacts the controllable profit, because depreciation also, um, otherwise in other sense, in other situations, we generally call depreciation amount to be as uncontrollable cost. So it should not be affecting the controllable profit. But here in this particular question, one portion of it is controllable, one portion of it is uncontrollable. So on that note, depreciation also will have an impact on the profit available. That has reduced their profits, which is below um, target ROI of 18%. Calculation of RI. Let's take up RI calculation and then discuss advantages and disadvantages of both of them. Did we see WACC anywhere? So expected ROI is cost of capital is 12%. Sports company has a cost of capital of 12%. So I think we can calculate it here directly. RI is equal to this minus in bracket investment into 12%. Did I do it correctly? Minus 12%. Sorry. So both of them have positive RIs. RI is 804.5 for C, and E it is 1548. Both of them are positive. But um, see here, these are contradicting results. According to ROI, C was better. According to RI, E is better. Okay. Why is RI better here? Because we know that these are all an absolute values, higher investment, higher profit, larger amount of profits, etc. Therefore, RI in absolute terms also seems to be higher. And C has lesser investment, 11,000 only, and lesser profit, 2,125 only. Therefore, RI is also low. Okay, so that is how RI is calculated. ROI converted into percentages. So that part we have to do 4 marks. What are the advantages and disadvantages? Just now we've discussed in detail from the PPT. We need to talk about that. Advantages, disadvantages of ROI. Then this is RI. So it doesn't facilitate comparison between divisions because investments are different, profits are different. So RIs also are not comparable because they are different. They operate at different scale. So it is not comparable. Advantages of what? Disadvantage of not accepting the projects with lesser ROI than the standard ROI. That issue would not be here as such because the decision criteria is as simple as whether it is positive or negative accepted. Okay. Um, the cost of capital would be adjusted for different businesses. Cost of financing a division is brought home to div. So now divisional managers will also take up the responsibility of uh, meeting at least the cost of capital, earn profit as much as that they can meet the cost of capital, apart from anyway the operating expenses. Okay, so that is about it. So I hope this is clear. This is a very simple question. So any question that is given involving calculations of ROI, RI, you should be able to take it up. The rest of the questions you can study from exam kit. The intricacies I have discussed about it. So let's get back to the syllabus file. So if we look into the syllabus file, what are the other topics? Then we can proceed further. Okay, so C section, C bit of the section 2. Evaluate the interdivisional transfer pricing and methods of setting transfer prices, market-based, cost-based, and negotiated transfer pricing, and then discuss about BSC, balance scorecard. So divisional performance measurement and transfer pricing. So now transfer pricing concept makes it makes sense, or it is very easy to understand that in the context of calculation of ROI and RI, because these things are calculated and the managers are evaluated based on what is ROI. So at this point of time, the criteria of the managers is to ensure that they have good ROIs. They should not take any decisions which affect their ROI or RI. In this context, already transfer pricing concept, you know that whatever is produced by one division, if it is required by another internal division, so that they could use that material to produce something else. So in that case, what is the price at which the material is transferred by one internal department to another internal department? That's the concept of transfer pricing. What are the objectives? I think you know these objectives also. We've discussed a case study earlier about what are the objectives of transfer pricing. See, ultimately, it should be that if the criteria is to ensure that they have good profits, their evaluation is based on good ROIs, etc. But nevertheless, the focus also should be on accommodating other divisions, because ultimately it is the overall organization performance and the achievement of the organization goals which is more important than individual departments goals and objectives. So goal congruence, everybody has to aim at achieving the organizational objectives, so they understand the objectives of the organization on the same level and same note. So that's about goal congruence. Then we see the it is useful in measurement of performance when um, um, the transfer pricing concept of it is uh, focused on that. At that time, it also considers about that the um, performance uh, evaluation also would be eventually taken up. So the price is not set like anything just to help the other division, but it also considers that uh, there would be a performance measurement as well. So performance measurement also should be considered while deciding the transfer price. They have the autonomy to decide whether they want to transfer it or not. That autonomy is there. Minimizing global tax liability. See, in situations, we did discuss one question on transfer pricing where um, because of the uh, differences in the tax rate, would it be appropriate to um, buy it from the local supplier, or in fact actually take up the or transfer the material to other units of the organization located in other countries. So, if there is a benefit of reducing the tax liability by transferring the material, it should be taken up. Okay, to record the movement of goods and services, how they are, what is the flow of material, etc. Fair split of profit between divisions. So, whatever is the benefit that is enjoyed by one division, by transferring to the other divisions, that benefit is also shared with other divisions. Okay, these are the objectives of transfer pricing. The methods of transfer pricing, if, when we look into that, transfer pricing general rule, transfer pricing, what are the methods technically? Um, we see that when there is spare capacity in a perfectly competitive market, I'll start with this one. In a perfectly competitive market, all what they produce can be absorbed by the market. It can be sold in the market. Um, the transfer price will be as equal to as whatever is the market price. There is no need to bring down the price to to sell it to the internal department, because if one division makes a profit, it is the profit for the overall organization, because all the units can be sold at the market price in the market. Then I think there is no need to transfer the material to the internal department, or even if the transfer takes place, it should take place at the market price. That's per situation. if there is a if there is a spare capacity available, because at the present capacity level, the fixed cost is completely taken care of it. So if they are operating at a scale, let's say that if this is a scale of 0 to 100% capacity, and operating if they are operating, let's say at some capacity level, let's say 60%, so the products that are produced and sold at a capacity level of 60%, would take care, the revenue that is generated at this level will take care of the total fixed cost and the total variable cost. So total fixed cost is completely absorbed at this level. So selling price that is decided accordingly. So now with this unutilized capacity or the spare capacity, if they want to utilize, operate, produce additional products and then supply them to the internal department, then in that case, it is only the variable cost which will be incurred. Only the variable cost. So the transfer price can be as low as the variable cost. If they can recover the variable cost, that is sufficient. They would be able to accommodate the other department. So anything like a variable cost plus a profit margin could be the transfer price. If there are production constraints, which means that they are already operating at 100% capacity, this is the second one. If they're already operating at 100% capacity, then in that case, to accommodate the internal department, some of the units or some of the products in the product line which are already produced and sold to the external customers will be cut down. Will be cut down, and these resources will be transferred or will be utilized to produce units that can be transferred to the internal department. By cutting down on the number of units, there is some amount of contribution which would be foregone. So that foregone contribution is opportunity cost. That opportunity cost should be added to the variable cost. Variable cost plus the opportunity cost of not using those resources elsewhere. So whatever is that opportunity cost should be added and decide the transfer price. Okay. I did explain once again. All this I explained earlier in APM, but I did once again explain in situation you might have missed it. That's the only concept there. Either it is market price, production cost plus markup, or negotiation. What should be considered? What should be considered is that digital performance measurement. No, this is about digital performance. So this is about transfer pricing. Today I will not start a case study on transfer pricing. We will see about what is balance scorecard. Where is balance scorecard? Sorry. Okay. In connection to performance measurement, there is a model called as balance scorecard model, which is used to measure the performance. I'll explain this and I'll wind up the class. Or I'll do something else also. Let's see. See for when the performance of the organization is measured, the performance of the entire organization to be measured may not be very simple for certain organizations because the size of the organization could be very big with multiple departments, divisions, activities going on. To look at the organization as a whole and measure the performance may not be possible. It's not simple. So for that reason, the organization would be looked at from four different perspectives. So we have this as financial, customer, internal business process, and innovation and learning or learning and growth, whatever terms. They would be looked into from four different perspectives, or they are divided into four different